Hello everyone and welcome to the Market Share. My name is Erik Clapsaddle. I'm the Senior Fixed Income Portfolio Manager in our Investment Management Group, and with me today is Rob Romano, fellow Portfolio Manager who heads up our Equity Research and Asset Allocation Committees. I know everyone's expecting a 5-minute video today on the Federal Reserve's cut last week from 5.5% to 5%, but today we come with a gamut of issues that we think are a little bit more important in the short term. Rob, let's talk consumption. We write about it, we talk about it regularly, but it's such an engine for economic growth here in the States, nationwide, and throughout the world. Give us an idea of what we're seeing today and some trends.
Thanks, Eric. You are correct. The U.S. consumer has been the engine of economic growth, and we've been surprised how resilient the consumer's been. But we're starting to get some evidence that the consumer is slowing here, especially when you consider that the savings rate is now below 3%, and the most recent consumer confidence number that came out. So on this graph here, what we have is we break out spending by goods and services as a percent of total spending. And on the bottom line, you can see the goods spending and the big spike up as the service side of the economy was shut down. But more recently, goods spending has really tailed off and it's back to the long-term average. And the reasons there is really twofold. One is we had this massive pull forward in spending on goods. And secondly, we have higher rates. So higher rates mean bigger ticket items are more expensive. On the top line, we have service spending. And that collapsed as the service side of the economy was shut down, only to see that spending increase significantly when the economy was reopened. So we saw big increases in spending on experiences, travel, leisure, entertainment, and so forth. But now we're back to the long-term average. And we're getting some evidence that spending on services is slowing. When we look at the ISM Service Index, that's down from its highs quite a bit. We do get some data on bookings, and that's pointing to softer bookings for hotels and airlines. And lastly, we did get a forecast from Deloitte on holiday spending, and it's expected to grow at its slowest rate since 2018.
Well, consumption of goods is very rate sensitive. Goods like autos, RVs, boats, large appliances, really anything that needs financing. And yes, the Fed cut interest rates by 50 basis points recently, but they also have manipulated rates through their balance sheet. A very large balance sheet that holds government securities, includes treasuries. Give us an idea of how that's taken shape over the past few years.
Sure. So the Fed can buy bonds, also called quantitative easing, and it does this, as what Eric said, as a way to suppress rates or keep rates low. And that makes financing much easier for consumers to refinance a home, buy a car, and for businesses to expand or buy equipment. Lower rates are also bullish for asset prices. So think of house values today. Ben Bernanke, former Fed chairman, had a really good quote when he said a 1 percentage point decline in the 10-year Treasury yield is equal to a 3 percentage point decline in the Fed funds rate. So on this graph here, you can see the Fed balance sheet. So pre-pandemic, it was $4 trillion. That's that horizontal line. And then you see the big spike up. That was when the Fed bought a lot of bonds, a total of $5 trillion, and the balance sheet peaked out at $9 trillion. So if you think of all that bond buying by the Fed, you combine that with the spending from the fiscal government, and really the combination of those two fueled the inflation we've had the past few years. But as the economy has reopened, the Fed has allowed that balance sheet to roll off a bit, and now we're back to about $7.1 trillion, which is down from the peak, but still historically high.
Yeah, obviously it's our job to understand the markets, the economy, how things are correlated, but it's also our job to apply it to portfolios. The stocks we pick, the bonds we pick, the way we allocate assets and sectors we choose, and ultimately that depends upon the health of corporate America. With second quarter earnings pretty much fully released, How has that also taken shape over the second quarter?
Yep, good. No, earnings were a bright spot. So earnings came in up about 10%. Expectations were for 8.9, so nicely ahead. Revenue was healthy at 5.2%. And when you think of revenue, a lot of that growth really came from technology, semiconductors, softwares, kind of the build out of the data centers. Less of that growth came from areas of the economy that are more cyclical, that are more tied to rates that Erik talked about previously. You think of housing and Home Depot and Lowe's as an example, both said their same-store sales are going to be negative for the full year. Auto sales are well below the peak of 2019. But on this graph here, you can see that for the remainder of 2024, we're expecting, a calendar year earnings of up 10% to $241 per share. And as we look to 2025, analysts are currently forecasting an acceleration in earnings of 14% or $275 per share. Again, we think that's a bit optimistic when you consider the overall slowing in the economy. But we would say that a big boost to earnings has been the margins. Margins have held in, again, better than we would have expected. And again, you can't underestimate corporate America and their ability to really cut costs, become more efficient and more productive.
Thanks, Rob. Appreciate your insight into the markets, the economy, and ultimately it's good to hear that corporate America is healthy. If you enjoyed this video, please feel free to share with your friends, family. If you aren't subscribed to the Market Share, hang on to the end of the video, scan the QR code, enter your email, and you'll be subscribed. Most importantly, thank you for the opportunity to serve you and your family. Have a great day.